They told you Africa's financial future would be built in Lagos, or Nairobi, or Johannesburg. They were wrong. Right now, billions of dollars are moving through a tiny island in the Indian Ocean, an island most people only know as a honeymoon destination. And the people routing that money, they're not hiding it, they're doing it completely in the open, with the full blessing of governments on 5 continents. This is the story of how Mauritius became the most strategically important piece of real estate in the global financial system that nobody is talking about. And by the end of this, you're going to realize the blueprint they used has been hiding in plain sight for 60 years, borrowed from a city-state that rewrote the rules of modern capitalism. Let's start in 1968. Mauritius gains independence from Britain. No oil, no minerals, no strategic land border, just 2,000 square kilometers of volcanic rock, surrounded by ocean, with an economy almost entirely dependent on sugarcane. The Nobel Prize-winning economist James Meade, the man they called in to assess the new nation's prospects, basically wrote it off.
The unemployed, or large part of them.
He predicted chronic unemployment, ethnic tension, and long-term economic stagnation. His report was so bleak it bordered on a eulogy. Fast forward to today. Mauritius has a GDP per capita higher than South Africa, Brazil, and China. It's ranked the most economically free country on the African continent for over a decade running. Over 24,000 companies are registered there, many of them multinationals, using Port Louis as their official base of operations for the entire African continent. How does a sugar island become the financial nerve center of a 1.4 billion person continent? The answer starts with a decision that Mauritius made quietly decades ago, a decision to be useful to everyone and loyal to no one. Here's something most people don't understand about global finance. Capital is cowardly. It doesn't go where the opportunity is greatest. It goes where the risk is lowest. And risk, in the context of Africa, is enormous. Political instability, currency volatility, regulatory unpredictability, corruption, expropriation, the list goes on. A multinational corporation wanting to invest in Uganda, Mozambique, or the DRC faces a terrifying array of legal and political landmines. So what do? They don't invest directly. They route their capital through a third country, a stable, treaty-rich jurisdiction that acts as a legal buffer between the headquarters and the target market. A place where the rules are clear, the courts are independent, and the government has signed ironclad agreements with almost every country on the planet. That place is Mauritius. And here's where it gets geopolitically fascinating. Mauritius has pulled off something almost no other nation has managed. It's simultaneously trusted by the West and welcomed by the East. American and European private equity firms use Mauritius as their gateway into Africa. But so does India. And this is the detail that most analysts miss. A significant portion of all foreign direct investment flowing into India has historically been routed through Mauritius. Not because the money originates there, but because Mauritius's double taxation avoidance agreement with India, one of the most favorable tax treaties ever negotiated, made Port Louis the logical staging post for global capital entering the subcontinent. China's Belt and Road-affiliated investment vehicles have also used Mauritian structures for African infrastructure deals. Gulf sovereign wealth funds, European family offices, they all pass through the same door. Think about that for a second. In a world increasingly defined by US-China rivalry, by sanctions and counter-sanctions, by friendshoring and economic nationalism, Mauritius has somehow managed to be everyone's friend. That's not an accident. That's a deliberate, surgical foreign policy strategy. They've built a network of over 46 double taxation avoidance agreements, more than almost any African nation, covering jurisdictions across Asia, Europe, and increasingly Africa itself. And in 2026, they're doubling down, positioning the island as the premier hub for green finance in the global south, packaging climate-linked bonds and ESG-compliant investment structures that appeal to the new wave of sustainable capital flowing out of Europe. Neutrality, it turns out, is not a weakness. In the right hands, it's a superpower. Now here's where I need you to really pay attention, because what Mauritius has built operationally is, quietly, one of the most sophisticated financial ecosystems outside of traditional Western hubs. You want to set up a company in Mauritius? You can do it in 48 hours, not weeks, not months, 48 hours. The Financial Services Commission offers what they call sandbox licenses, regulatory frameworks specifically designed for fintech innovators, crypto platforms, and alternative asset managers who don't fit into conventional categories. In most jurisdictions, novel financial products spend years waiting for regulatory clarity. In Mauritius, they get a controlled environment to operate while the rules catch up. The result? Port Louis has become what insiders call a de-risking station. A multinational wants to build a copper mine in the DRC or launch a mobile payments platform in Nigeria or acquire a portfolio of Kenyan infrastructure assets. They don't expose their parent company directly. They create a Mauritian holding structure, clean, legally ring-fenced, tax-efficient.
Mauritius is open for business, for domestic investors and international investors. We have always been a very business-friendly investing environment.
And from there, they reach into the continent. The capital flows are staggering. Mauritius consistently channels more foreign investment into Africa than almost any other jurisdiction.
Mauritius has done really well. It has become the gold standard for fund management, for fund administration, and for funds domiciliation. It has really done extremely well as a hub for cross-border and international investment.
Despite having an economy smaller than Luxembourg, the island punches so far above its weight that it barely registers as the same category of entity as the countries whose money it manages. And it's not just the legal infrastructure. Mauritius has quietly built a talent pipeline to match. Bilingual professionals, English and French, trained in international finance, arbitration, and compliance. University partnerships with institutions in London, Paris, and Singapore. A digital infrastructure robust enough to support real-time cross-border transactions across multiple time zones. The machinery is real, and it runs. But here's where the story gets complicated, because nothing this good comes without a price. The OECD has had Mauritius in its crosshairs for years. The European Union has repeatedly placed and removed the island from its grey list of non-cooperative tax jurisdictions. The pressure is constant. Harmonize your tax rates, share more information, close the loopholes, stop being quite so useful to people who'd rather not pay taxes in their home countries. And this is the existential tension at the heart of the Mauritian model. The same features that make it attractive to legitimate investors also make it attractive to those who are less legitimate. Transfer pricing abuse, round-tripping, where companies send money to Mauritius and bring it back as foreign investment to take advantage of treaty benefits. The offshore model has a shadow side, and Mauritius has had to reckon with it. There's also a deeper domestic cost that rarely makes the headlines. While Port Louis handles billions in global capital, the average Mauritian has watched housing prices soar beyond reach. Foreign real estate investment has turned parts of the island into a playground for ultra-high net worth individuals from Europe and South Africa, pricing out locals in their own country. The offshore boom has created a dual economy, a globally connected financial sector on one hand, and a population increasingly squeezed on the other. Mauritius has responded to the international pressure with characteristic strategic agility. They've signed up to OECD-based erosion and profit-shifting frameworks. They've improved beneficial ownership transparency. They've pivoted hard toward wealth management, family offices, impact investing, ESG funds that sit comfortably within global compliance norms rather than exploiting their edges. The message to the world: we're not a tax haven. We're a sophisticated international financial center. There's a difference. Whether the world believes that distinction depends on who you ask. Here's the twist I promised you at the start. Everything Mauritius has built, the treaties, the regulatory agility, the neutral positioning, the talent base, was not invented in Port Louis. It was imported from Singapore. The parallels are almost clear. Singapore in the 1960s, a tiny island, no natural resources, newly independent, surrounded by larger and potentially hostile neighbors. Lee Kuan Yew's solution was simple, in theory, savage in execution. Make Singapore so useful to global capital that no one could afford to see it fail. Strict rule of law, clean courts, radical openness to foreign business, English as the language of commerce, ruthless suppression of corruption. Mauritius studied that playbook and adapted it for the African context. Different geography, different history, different geopolitical stakes, but the same core logic. Make yourself indispensable. Be the stable node in an unstable network. And for a long time, it worked spectacularly. But the next decade presents challenges that Singapore never faced. The African Continental Free Trade Area, AFCFTA, is slowly, imperfectly, but genuinely integrating 54 African economies. As cross-border trade within Africa becomes easier, as African capital markets deepen, as Nairobi and Kigali and Casablanca build out their own financial infrastructure, the question becomes, does Africa still need Mauritius? Nairobi's financial sector is growing fast. Rwanda has positioned Kigali as a tech and finance hub with aggressive incentives and a reputation for governance that rivals Mauritius on some metrics. Even Nigeria, despite its turbulence, is developing sophisticated financial structures that could eventually compete for the intermediary role Port Louis currently owns. Mauritius has a head start of decades. It has treaty networks that took 30 years to build and cannot be replicated overnight. It has institutional trust, the kind that only comes from consistently not collapsing when everything around you is collapsing. But head starts run out, which brings us to the fundamental question that Mauritius, and frankly, every small nation that has chosen this path, must eventually answer. What are you, really? Are you a sovereign nation with a national interest to protect? Or are you a piece of global financial infrastructure, a node in a network, valuable precisely because you subordinate your national character to the needs of global capital flows? Singapore wrestled with this question and chose a third option: become so wealthy, so capable, so internally cohesive that you can be a node in the global system without losing yourself in it. That required decades of firm governance, aggressive social investment, and a social compact that exchanged certain political freedoms for material security. Mauritius is a democracy. It has a free press, competitive elections, and a vibrant civil society. That's genuinely admirable. It also makes the Singapore path harder to replicate. The real test for Mauritius isn't whether it can attract the next $1 billion of foreign capital. It probably can. The real test is whether the prosperity generated by the offshore model actually reaches the Mauritian people. Whether the island that became Africa's financial gateway can avoid becoming a country that serves the world while shortchanging itself. Because here's what the Singapore story actually teaches, if you read it carefully enough. The miracle wasn't the money. The miracle was that the money built something: institutions, infrastructure, human capital, a society that could sustain the model across generations. Mauritius has the money. The question is whether it's building the something. And that question, that unresolved, uncomfortable question, is precisely why what happens in Port Louis over the next decade matters far beyond the Indian Ocean. It's a test case for whether small nations can use global finance as a tool for genuine development, or whether global finance inevitably uses them. Watch this island, because the answer it finds will be studied in every finance ministry on the African continent and in a few chancelleries far beyond it. So here's what I want you to think about. We talk endlessly about China's rise, America's decline, the scramble for Africa's resources. But the real power in the 21st century might not belong to the countries with the biggest armies or the most oil. It might belong to the countries that figured out how to be indispensable to everyone, all at once. Mauritius figured that out 50 years ago. The rest of the world is only now starting to notice.